Hello, traders. This is Dave with the SPY Super System Options Trading Room and Alert Service. And I'm doing a kind of a training video tonight for SPY Super System members and anybody who's interested in the SPY Super System, which is a piece of software we use to identify when institutions are in trades and when they're not, and how we build high probability trades around that. But tonight, what we're going to be talking about is the major reasons nearly all retail traders are unable to be consistently profitable. It's unfortunate that a lot of retail traders, most retail traders, are not able to become consistently profitable. And I'm going to try to highlight what I think is the most important mistakes that most retail traders make to keep them from becoming profitable. A lot of retail traders have good methodologies. They can follow like the methodologies we do here, but they're unable to become consistently profitable because of mistakes made during their training. So we're going to cover those tonight, and hopefully it'll help to at least identify them and maybe be able to make some changes to become consistently profitable. All right, so first thing I have to do here is talk about the disclaimer. All signals and trading opportunities we provide are for educational and demonstration purposes only. Trading is very risky, so you should never trade with more money than you can afford to lose. And neither myself or Right Line Trading are licensed financial advisors, so we won't be giving financial advice. Okay, first let's talk about what you need to have an edge over the other retail traders as a profitable trader, which is one of the things that the SPY Super System Trading Room brings to traders. We have a methodology that we use every day, 5 days a week, using options for the most part, that allows us to have a methodology that is successful trading highest probability trade setups. So basically what you need to become a profitable trader, you have to have an edge. And this is what our edges are. We have the SPY Super System piece of software that runs on Thinkorswim. I don't have to trade on Thinkorswim, but it runs on Thinkorswim. And that helps us identify when institutions are in a trade and when they're not. We only want to be taking trades and institutions are driving the trend. With trade relative strength and relative weakness, this is another thing that most retail traders don't understand. It's not RSI. This is when a stock that you want to trade is outperforming the SPY or the Qs. If the SPY is moving sideways and down, and you've got a stock that's stacking green candles, it's got relative strength, and it's typically going to outperform the market. Even if the market turns against you, your stock will outperform the market, allowing you to either maintain profits or just get out of a small loss, even on a pull down against you. So trading relative strength and relative weakness, number two of the what you have to do. We have the SPY Super System software to tell us institutions are in the trade, and then we look for relative strength and relative weakness. We also trade with the market trend if there is one, and then we try to buy at support and sell near resistance. And that's really important. We don't want to be chasing stocks, and we're going to talk about some of the problems that retail traders have when they do try to chase stocks. Okay, now we have a couple of rules to trade by. We trade the best and skip the rest. This is easy to say, difficult to do, but the whole point here is to only trade the highest probability trade setups that are available to us. Skip the rest is the hardest thing for most retail traders to do. If they don't have a trade on, they get bored and they start to try to find other trades. This is the key thing. If you can skip the rest, this will be more of a help to you than trading the best. This will save you more money in the long run. And then it's important to understand that our objective is not to make trades. Our objective is to make money. And again, this is focused on not taking too many trades. We're just going to only take the best trades we can find. So we don't even think about how many trades we're taking. We're thinking about only taking the high probability trade. So again, our objective is not to make trades. Our objective is to make money. Maintaining discipline is also a very key element, a very key criteria. That means sticking with your methodology. Don't be wandering from indicator to indicator on things that you've read about or heard about. Stick with the disciplines that we in the room. This particular strategies that we use. Maintain discipline and remain patient. Look for stocks to set up. Don't be chasing them around. This is going to be one of the things you're going to see in the list of the biggest errors that retail traders make to keep them from becoming profitable. Remaining patient is very, very important. Okay, now the compass system, or the SPY super system, as it's called, is a piece of software that runs on Thinkorswim in Ninja, but I use it on Thinkorswim. You don't have to trade on Thinkorswim, but it runs on Thinkorswim and identifies the highest probability trade setups while sidestepping setups that look good but will fail, because it tells us when the institutions are in the trade. It does this by identifying when institutions are driving the move and when they're not. And it analyzes a lot of complex trading data and displays the results in an easily identifiable format. It's visual, but colors, very easy to see. And the visual elements make it possible for even new traders to find high probability trade setups. I'm not going to go into too much detail about this tonight because I'm going to focus on mistakes that traders make, but we'll at least show you what the chart looks like. How do we get an edge over other retail traders? And remember, you're trading against other retail traders. You're not going to beat the institutions. You're going to trade against other retail traders. And if you've got better software or better knowledge than they do, if you know when the institutions are in the trade, if you know how to trade relative strength, relative weakness, if you know how to trade in the direction of the market, if you know to get into that support and resistance, you're going to be ahead of about 99.5% of the retail traders in the world. That's why most of them lose. And this gives us an edge because our trades will be supported by institutional buying and selling. The stocks will be outperforming the SPY or the Qs, and they'll be moving in the direction of the overall market. So this is what gives us an edge over other retail traders. In other words, we're going into a battle with other retail traders every day, trading the market, and we've got better software than they do. We have better information than they do. We have better methodologies than they do. All right, and this is just, I'm going to go over this very quickly, just so you know what drives the market. These little marbles are retail traders, such as myself and most folks watching this. Retail traders cannot move the market. If the institutions are not in any force, retail traders are just going to chop around and cause chaos and chop, and you're not going to be able to make any money. So you don't want to be in the market or in the stock when the retail traders are the only ones in there for the most part. In other words, there's no significant move that's being done by the institutions. Now, the institutions, which are made up of investment banks like Goldman Sachs, JP Morgan Chase, Morgan Stanley, they make up a big portion of the institutional money. But there's also pension funds in there. There's also hedge funds in there, and there's also mutual funds in there. All of these particular organizations or institutions are what drive the market. And this is where there's billions and billions of dollars. And when they're in a trade in any kind of force, then they're going to be able to move it. And they can move it up and they can move it down. And our job is to identify when that happens. And you have to remember that the institutions have trading desks where they actually have humans making trades, but that's not very much. I mean, they're pushing buttons, but most of their trades come from what's called algos, or computer programs that are written to identify specific situations or setups in the market, or news. They read news and trade off of that. If you've ever seen how the market reacts to, for example, the jobs report on a Friday morning, or the FOMC, the Fed, when they raise or lower rates, if you've ever seen that, the Fed report comes out exactly at 2 o'clock on a Wednesday afternoon, and at 2 o'clock, in a couple of milliseconds, you're going to see these big moves in the market up and down. Humans aren't doing that. Those are algos that are trading that information. So that's what we want to be able to identify. Okay, and this is I just kind of wanted to show you this SPY super system. This is the actual software that runs on Thinkorswim. This is what I use to find my trades, for both on an intraday trading basis and a swing trading basis. And basically, we've got 4 indicators here. Right here we have 3. I'm sorry. Long-term trend, which is this line here. Red and yellow is short, or bearish, and red and green is bullish. Right. So red and green, red and yellow are bearish. Blue and green are bullish. So this is a trend line. This is multi-time frame momentum. This and this, which is current time frame momentum. These are the key indicators that I use to find intraday trades and swing trades. These need to be aligned with red or yellow for short and blue and green for long. So if this was a chart that you were trying to go with a swing trade, if this was a daily chart, which it's not, it's 5 minutes, you're not going to trade it because you don't have confluence here between the multi-time frame momentum and the current time frame. And this is the actual oscillator down here that drives this particular momentum indicator. So again, this is on multiple time frames, and this is on current time frames. And when these align, when we get reds in these, this tells us the institutions are selling. When we get greens, it tells us the institutions are buying. And when it's just flapping around, we know that there isn't enough force in there to trade with it. But this is what it looks like. We have a few indicators on the 5-minute chart that we use religiously. The 15 EMA is right here. That becomes the support or resistance level for us. And this is the VWAP, the volume weighted average price. These are where we do our intraday trades. If we're trading SPYs, Qs, or any stocks that we're just going to be in for intraday, we're going to use the VWAP by the 15 as support and resistance levels. On a daily chart, you're not going to be using any VWAPs. You're going to be looking at much higher level indicators, 200-day moving average, 100-day moving average, the 50-day moving average, things like that. And this is a pivot point that the SPY super system generates. These are very, very effective as far as support and resistance levels. And the SPY super system also creates these pop out of the box symbols right here, these arrows. These tell us when a stock is breaking down out of compression. And if it was blue, I mean, yellow would be green. I think it would be breaking out of compression, but that's generated by the software. All right, so that's what the SPY super system software looks like. We also have another template for intraday trades only. If you're trading just the SPY, the Q, the IWM, or you just want to trade intraday, you're not going to be taking anything overnight, you're not going to be taking for a long period of time, then you also get with the software, if you buy the software, you also get this template, which basically just shows the current time frame momentum right here, and the VWAP, the 15 EMA, and you pop out of the box or compression symbols right here. So if you were looking, for example, on the SPY and you wanted to go long the SPY, you see how it's green and then goes to yellow and then goes back to green, and the stock breaks above the 15. It's breaking above the support level, resistance level. You take it right here and you ride it up and you get out as it flattens out. See how it went back to yellow here? That's your trade right there. For on the SPY, that would be a fairly quick trade here, probably 20-25 minute trade, and for a nice little profit. But that's how we use this for our system. Again, I'm not going to get into details about this tonight. I'm going to be focusing on the errors traders make. But I did want to just introduce you to it in case you're not familiar with it. All right, so the most common mistakes that retail traders make. Right, these are the mistakes that, and I try to rank them in a something of an order of importance. Right, and these are the 11, and then I'm going to go into some detail. First one is not considering the current market conditions. This is a very, very important error. When a trader goes in there and looks at a 5-minute chart, they see a stock that looks pretty good, but they don't consider what the stock's been doing so far today on the 5-minute chart. Is it trending up? Is it trending down? So not taking that into consideration on your day trades or your swing trades is a huge, huge mistake. The market drives most stocks, and if you're not paying attention to that before you get into a trade, you're going to have some big problems. Second thing, over trading, taking too many trades. And this goes right back to patience, but over trading is a big problem for most traders. They just cannot sit and be patient and not take trades when they shouldn't be taking trades. Number 3, and we're going to go some more details on this, trading your P&L instead of the technicals. If you're watching your P&Ls to see if it's red or green, going up, going down, what you end up doing is you're trading off of emotion. As the stock goes green, you're feeling good. It goes red, you're feeling bad. You bail on the trade because it's going red. But you got into trade. You should have got into the trade based on the technical setups of that trade. Nothing to do with how much money you're making or losing. Whether you're making money or losing money is not indicative of whether it's a good trade or not. The technicals tell you whether it's a good trade, and you just have to give it time to work. But if you're watching your P&L, you're going to be in big trouble because you've immediately put emotion into your trading, and you don't want to do that. Not using the daily chart for swing trades. This is another big problem. A lot of traders will see a nice 5-minute chart, and they'll decide they want to go ahead long or go ahead short because the 5-minute chart looks good, either bullish or bearish, but they don't go and look at the daily chart. So they end up taking a stock long off the 5-minute chart because they think the chart looks great without looking at the daily chart, which when you look at it, it finds out it's bearish as heck. There's no way that stock should be taken long. It certainly can't be kept all day if it goes against you, and you certainly can't hold it overnight. So you need to be looking at the daily chart first on any swing trades that are gonna last part of the day, even a few hours, you want to be looking at the daily chart. You don't need to use it on very high speed intraday trades off the 5 minutes that you're only going to be in for 10 or 15 minutes. But for any other trades, you need to be looking at the daily chart first. Number 5, this is a big one. Trading what you think, not what the price says. We're going to get into some details on this. People have a bias because they've read something or seen something or heard something, and they end up trading based on that. Not what the price is doing, but what they think is going to happen. Huge mistake here. Number 6, over leveraged. You take too much risk. You put too much risk on, you immediately just start to trade on emotion, because when you've got too much risk on, any kind of a pullback or any kind of the market stock going against you is going to freak you out, and you're going to end up getting out of the trade because you're too leveraged on it. You can't trade the way you want to because you've got too much risk on. Lack of patience, number 7. Lack of patience. This is again a huge one. This manifests itself in so many ways that will really hurt your trading badly. Forcing trades, which is kind of part of lack of patience. Forcing trades that you, in other words, you're bored. You want to take a trade, you haven't had a trade on for a couple hours, so you force one, or you justify of how good this trade looks, even though it doesn't meet the criteria. Number 9, attempting to pick tops and bottoms. The stock can't possibly go any higher. I got to short this thing. The stock can't possibly go any lower. I'm going to go long this one. Attempting to do this without any indication price-wise that any bottom or top has occurred. And not waiting for confirmation to enter a trade. We'll talk about this a little bit. This is kind of this is more of an interesting one. And then FOMO, fear of missing out. And again, this happens most of the time early in the day when the market gaps up, and some stock is Netflix is ripping up green candle after green candle. The traders are looking at the thing and they feel like I'm losing a big opportunity to make a lot of money here, and so that's fear of missing out. And what do? They jump into the trade, and lo and behold, most of the time the trade, they get in right near the top, it reverses and goes against them. And it may be a good trade by later in the day, but you want to wait for it to come back to support and then take it on the way back up again. So that's FOMO, and that's again, it's basically just greed taking over. And again, FOMO is emotion. Anything that when you're fearing something, fear of missing out, it's emotion. So we don't want to be trading on emotion. So those are the 11. And I'm going to go into some detail on each one of them here. All right, for first thing, all right, not considering the current market conditions. Right, so let's think about this. You want to take a look at the market, both the daily chart, but especially the 5-minute chart when you're intraday trading. Do you have a bullish or bearish trend? Is it choppy and trendless? Are you getting a pop and drop or a drop and pop? Is the stock just the market gapping up and then pulling back, gapping down and then moving up? And then you want to know, is it above the previous day's high or below the previous day's low? If it's in the previous day's range, if it hasn't broken above the previous day's high or below the previous day's low, those are called the inside days. So you're not getting an awful lot of movement in the market. It typically end up being choppy and trendless. So that's what you need to identify. All right. So why is this important? Well, because the conditions of the market make this determination. A, if you should be taking trades at all. If we're in what's called a low probability trading environment, into a candle that's trading inside of the previous day, it's just chopping around, going up above the VWAP and down below the VWAP, you basically shouldn't be taking trades. I mean, there's going to be some standout stocks that you may be able to take, but you should generally, the number of trades you take should be very, very limited, and the size should be very, very small. The size and the risk of the trades to be taken depends on the market. Bullish and bearish trending days, you can take larger size and you can stay in the trades for longer. You see, you can take some more risk because you're trading in the trend. You've got an opportunity for that to keep on going and giving you some bigger profits. When it's choppy, your profits are going to be minimized. Again, what the market's doing is going to tell you how long to stay in a trade, to take small or large profit targets. Choppy day, you got to take small profits. You can't be staying in there hoping that it's just going to keep on running when the market's choppy. Right? So on a trending day, you can go for larger profit targets. So a trending day, you can take more trades, larger trades, and stay in them longer. A choppy day, many fewer trades, much smaller risk, smaller profits. And how soon to exit for a loss? Well, if you've got a choppy day and your stock goes against you and you have a loss, you might as well just get out right then. Why wait for the rest of the day when there is no indication that we've got any kind of a trend to trade off of? Right. So this is the number one thing, and not considering what the current market conditions are is going to really hurt your trading if you don't take that into consideration. In the room, we do what's called SPY super system trades, which is trading the SPYs, the Qs, the IWM on a 5-minute chart. And one of the things I mention all the time in the room is if we'll see a setup that meets the criteria, but what is the market doing? Is this setup that's meeting the criteria? Is the market trending up, trending down, or is it choppy? Because that's going to make a big difference as to whether we take the trade and how big a size we take in the trade. And again, a lot of times we won't skip the trades if it's in a choppy, trendless day. All right, so that's number one. Number two, overtrading. This is just such a huge killer of most retail traders' money. They can get a couple of really good trades and they're up money, and they're making money by 11 o'clock. And then at 1 o'clock in the afternoon, they haven't taken any more trades, and they're sitting there and they're antsy. They're bored. So they start looking for trades to take and they start justifying it. They'll trade out of boredom. They'll start jumping into trades they see on social media. Somebody will post a trade. Oh, Netflix flying. This thing's going to go up 20% today. They'll see that in some social media post. They'll be moving from one trade to another quickly due to impatience. My stock's not moving as fast. Somebody posted a nice trade. I see. I'm going to get out of mine and get into that one. And trying to make up for recent losses or revenge trading. This is what creates a lot of overtrading. I'm sure there's other reasons, but these are the ones that just jump out at me. And this is probably the biggest one here, trading out of boredom, and also what you see on social media. But this is going to fall into another category as well here. All right, number three, trading your P&L instead of your technicals. I don't know how many times I've talked about this. When people are trading, you should be getting into a trade based on your technical setup, right? Whether you've got a stock breaking out of compression, breaking down out of compression, or whether you get a high Kinachi reversal candle or a bull flag, and it looks good, and they get into the trade based on technicals. You should only be getting out based on technicals. But if you're watching your P&L, you're going to get out based on what your P&L is telling you. So if you're in a trade and you're watching the P&L and you're up $300, and the stock pulls down, and now you're up $100, and it pulls down again, and now you're down $50, and now it comes back and you're up $50. Now you've got the sense of relief because you went from losing 50 to making 50, so you bail on the trade. So you bailed because your P&L told you up when you were just down. You're not bailing on anything to do with what the technical setups were. The trade is probably still a very good technical setup. You probably should be considering adding to the trade when that happens. But since you're watching your P&L, you get out of the trade. And this is a huge problem for most retail traders because they're so concerned about the money they've got in the trade that they end up watching that P&L and then they start making trades based on that. This leads to emotional trading. Oh my God, I'm losing money. I see this all the time. You might have a beautiful setup, but I'm losing money now. I can't take this. You've either got too much risk on or you're just watching your P&L. It leads to ignoring the technical setup that you used to enter. So now all of a sudden, the reason that you could be a successful trader, a retail trader, is because you trade your technical setups and you stay in trades based on those. But once you let your P&L take over, you're going to start ignoring the technical setups, and it leads to exiting a trade out of fear and undermines your confidence. All right, because you start to see this happen again and you repeat it over and over again. This is just an absolute horror show for traders, and it's really hard to do. I understand. One of the best pieces of advice I ever got when I started trading about 18 years ago was, as a trader, when I'm looking at the chart, treat it like a video game. Just pretend you're trading against a bunch of other retail traders, and it's a video game with a bunch of colored candles going up and down that you need to be able to understand and read better than they do. All right, not how much money you're making, how much you're losing, but it's a competition of a game against other retail traders. And that helped me a lot because I don't even look at my P&L. I don't even look at it until the end of the day. I mean, if I'm in a trade, I have a pretty good idea where I am. If a stock's moving up and it starts to lose momentum, I'll go ahead and take profits on it. But it's not because I'm looking at my P&L. And if it goes against me, I'm certainly not getting out based on my P&L. I'm getting out only if the stock breaks through support on a bullish side or breaks above resistance on a bearish side. Okay, so that's trading at P&L, another very important one. This is a guy that just traded his P&L today and saw the stock turn around to go up about 30% after he bailed on the thing. And this is what trading your P&L leads to you feeling. And you can see what we're talking about here. That's emotion. You know, this trading shouldn't be like a ride at Six Flags. You know, it's not on a roller coaster. Trading is a business. It should be as non-emotional as possible. Obviously, it's impossible to have no emotions in a trade, but you want to be as unemotional as possible, because as soon as emotions take over, that's what you're trading. You're not trading anything to do with the actual setups, and that's what you feel like when you've bailed on a trade that went way up on you if you had just stayed in it. All right, number 4, not using the daily chart for swing trades. All right, so this is anytime I take a trade, except for the SPY Super System trades where I'm trading on 5-minute candlesticks and I'm only going to be in the trade for a very short period of time. Any trade that I take even if it's just going to be a longer term day trade, if I'm getting in the morning and maybe getting out in the afternoon, I have to look at what the daily chart is first. That is the first thing I look at, the daily chart. If I'm going to trade Tesla, if I happen to like it long, I'm going to look at the daily chart to see if it's a bullish setup. If it's not a bullish setup, I'm not going to take it long for the day. I'm not going to take it long for swing, because if you don't look at the daily chart and you get in on a trade because the 5-minute chart looks good, and you get into the trade, and then it starts to go against you, you've got no staying power whatsoever. You've got no ability to stay in the trade overnight if the daily chart is aligned opposite to your trade direction. So please look at the daily chart first on any trades that you're going to take. All right, really important. Number 5, trading what you think, not what the price is. I could talk an hour about this because I hear this kind of stuff all the time. What asks traders, why did you take that trade? Well, I thought. It's always I thought, or I think, or I heard. All of those words should not be in any reason for you to be taking a trade. This is an insidious problem that creates a trading bias mentality, causing the trader to take trades based on what he thinks should be happening or what he thinks should happen, and convincing the trader to stay in the trade as it goes against him, regardless of the price action technicals showing the opposite, because he believes he's going to be right based on his invalid bias, the bias that he got based on something that he's read. Again, this can be created by listening to market prediction gurus, cable talking heads, reading on social media, expert posts, news and rumors. You know, we are going into a recession. I need to get short. We must be at the top or bottom. Time to get in. This is the kind of thing I hear all the time from retail traders. And when this is what you're trading off of, you're not trading off of a solid methodology. You're trading off of what you think, and what you think has been influenced by what you read or what you hear. Please don't pay any attention to it. You know, all I've got on during the day is a news feed where I get actual news relative to individual stocks and unusual option activity, things that actually have an impact on the market. I'm not listening to the talking heads on Bloomberg or CNBC or anywhere else that are out there telling you that you should buy IBM or should sell Microsoft. I'm not listening to any of those people. Trust me, they don't know any more about what the market's going to do than you do. The only thing that tells us what the market's going to do is our information that we have based on the SPY Super System as far as institutions and price action. That's what tells you what the market's going to do. These folks don't have any more idea than you do. And I'm sure you've heard this before. You know, they go out there, they tout a stock. They have 5 stocks they talk about. One of them hits, and they're bragging about it all the next week. Meanwhile, if you took the other 4, you're losing your shirt. So please don't listen to these folks, and please don't trade what you think. Just trade what the price action is and what the indicators are telling you should do. That's extremely important. All right. And this is a Stephen Hawking quote. The greatest enemy of knowledge is not ignorance. It's the illusion of knowledge. And that is what you've got when you're doing this. You've got the illusion of knowledge, and you think you know something that you don't really know, And so you're trading that, and it's going to kill your money. All right. So again, the greatest enemy of knowledge is not ignorance, it's the illusion of knowledge. Okay, over leverage. This is another one. Too much risk on. Right. This happens sometimes when you have a couple of trades that you lose and you end up putting on a bigger size on the next trade. You've got too much risk. It's going to cause you to trade out of fear. Another case of emotional trading. You're not going to be able to stay in the trade based on the technicals and price action because you've got too much risk on. So it's important when we do increase our size. If the market is trending, we can take larger size. But I will tell you, if you're used to trading, let's say you're used to trading 10 contracts on options or 5 contracts or whatever you're used to trading, maybe you're used to trading $1,000 a trade, and you want to jump up. Don't jump up to $3,000 a trade. Move up to $1,500 a trade and do it for a bit, and then move up to $2,000 on a trade, because you'll be able to adjust to it much more easily, and you're not going to end up with the emotion involved in that trade as if you jumped up from 1,000 to 3,000. Believe me, mentally, it's going to have a huge impact on you. Right? So when increasing your trade size based on previous results and traders feel that they're ready to increase risk, do it in small increments so the emotional impact will be minimal. All right? Really important. All of these are really important. Number 7, lack of patience. You know, in the room every day, I tell you what I think, that whether it's a trending day or LPTE, we've had a lot of these LPTE days, low probability trading environment. For God's sakes, don't be taking a lot of trades on a low probability trading environment. You're putting your money at risk without high probability trades. They're going to be very, very low probability trades. You still may be able to make some money on them, but certainly take much smaller risk and take much fewer trades. Bored trading. This is lack of patience. Again, you're getting bored. You know, you want to stay in you want to have a trade on. Because I'm a trader, I'm going to have a trade on. Because again, our objective is not to make trades. Our objective is to make money. Not waiting for the high probability trade setups, not waiting for setups to confirm. Again, you're getting anxious. You want to get into a trade. This is all emotions. Chasing fast moving stocks with no regard to their overextension. This is part of FOMO as well. Chasing fast moving stocks. You see a stock open strong in the morning and it's stacking green candles, and you're sitting there looking at it, and you feel like you're losing a fortune because you're not in the trade. You finally crack and jump into the trade. That's lack of patience, right? It's critical, but that's lack of patience. And this is a kind of a good saying for being impatient. Impatient can cause wise people to do foolish things. And believe me, chasing the stock that's moving up on the open when you shouldn't be, that is a case of impatience causing wise people to do foolish things. Because you're going to end up thinking at the end of the day, if you lose money on it, why did I do that? Because you are impatient. Okay? And everybody suffers from this. You don't think I feel less when I see a stock ripping up in the morning that I wish I could get in that? You know, I've been through it enough to know that if I do, I know I'm probably going to be buying at the top. All right, forcing trades. Number 8. This is the most common reaction to lack of patience. You're going to go out there and force a trade. You come up with any number of invalid justifications for forcing trades that are always cited. I thought, I felt, I heard. This is what everybody says. When I ask somebody about a trade they took and I look at the chart and it looks terrible or it's way extended, I thought, I felt, or I heard. I thought it was going to keep going. Why did you think it was going to keep going? I don't know. I just thought it was. I had a feeling in my gut. Don't trade your gut. This is or this will be the other one you hear. It's just a small size. What they're saying when they're saying it's just a small size is, I know it's not set up, but I want to gamble on it anyway. Okay, that's a gamble. You know, admit it to what you're doing. You're gambling. You're not trading with any kind of an edge. You're gambling. Number 9, attempting to pick tops and bottoms. We hear this all the time. The market can't possibly go down or lower. NVIDIA can't possibly drop anymore. Microsoft can't possibly go up anymore. So you're trying to be first and prove how good you are. I was able to pick the pop and it moved down and I got in right at the top before anybody else did. You don't want to be first to anything. Believe me, you want to have confirmation that a trade is going to work. You're not going to be a hero doing this, all right? And you're going to end up losing way more than you win. And again, a part of that has to do with ego. And knowing the stock can't go any lower or higher. This is you're thinking. This is what you think. This is what you think. The price action is not telling you that the stock has bottomed out and it's heading back up again, but you think it can't go any lower. Look how low this is. This thing's down 50%. Tesla's down 40 or 50% from the beginning of the year. Can it go any lower? Of course it can. Wait for a confirmation that it's turned around and headed back up before you go long. Don't be early. Okay, number 10, not waiting for confirmation to enter. Now this is an interesting one because there actually are trades that you can take without waiting for confirmation to enter. Right? There's two different methodologies. This falls under predictive versus confirmed. So you can take a trade that's predictive versus confirmed. Predictive means if you're going to go long a stock when it comes down to support and then bounces up, and you take it right as it bounces off of support before it's actually confirmed by any more price action. That's called predictive. It's basically it's a reaction. So you can take it as predictive as long as you're taking this with an actual bounce off support or resistance. All right, you can't just do this willy-nilly. But there is a predictive versus confirmed. Now, not waiting for a confirmation can be used as a trading strategy if you enter a breakout or a breakdown on the first candle of the break, right? That's why it's called predictive. You're thinking that first candle is going to predict the move to the reversal back into the trend. They can work and you get in early for better profits, but they fail much more frequently. So you have to take that into consideration. You're taking into consideration that if you take a trade like that it's going to fail more frequently, but when the ones that do work, you'll make more money than somebody who is waiting for the confirmation because the confirmation is going to take another candle, right? But typically, I usually wait for confirmation. I find that it's much safer to do that. But not waiting for confirmation, I want to explain that there is actually a way to trade it, not waiting for confirmation, but you still there would be the reversal into the trend would have occurred. However, again, the error on not waiting for confirmation is most retail traders do on these trades is there is no regard for breakouts and breakdown. They just want to get into the trade. So that's just the ones that not waiting for confirmation. They're not waiting for anything. They're just jumping into a trade based on what they think is going to happen. It's got really nothing to do with confirmation. But even if the stock starts to reverse, they should be ready for confirmation, especially fairly new traders shouldn't be doing what's called the predictive one. They should be waiting for the confirms. But I did want to get into a little more detail on we're not waiting for confirmation because there are strategies that you can take it on the initial bounce. All right, number 10, ignoring support and resistance levels. When you go into a trade, when you look at the chart, you get into a trade, you've got to know how much room you've got to the upside for the bullish, to the downside, to the bearish, to justify taking the trade. If you're taking a trade and the stock is 10 cents away from the 200-day moving average on the daily chart, it's above it by 20 cents, and you're taking it long, you're not taking a trade that's got a good risk reward because you can expect that 200-day moving average is going to be resistance. So the stock is going to likely run into resistance there. So you haven't made enough money to justify taking the trade at all. Your downside is going to be much bigger than your upside. So you've got to know where your support and resistance levels are on the daily chart. It's critical to be used to determine if there is enough potential profit in the trade to justify the risk. And you've heard me talk about in the SPY super system, I'm looking at support and resistance on the SPY, the Qs, and the IWM. So I can, if I decide I want to take a SPY super system trade, I'm going to take the one that's the strongest for the long or the weakest for a short, as long as it's got enough room to the next support or resistance level. If it doesn't, then I'm going to move to one of the other indexes to trade it. It does have enough room to support a resistance level. Right, so it's always important to know with the daily chart where the 200 SMA is, the 100 SMA, and the 50 SMA, where they are on the daily chart and where the VWAP is on the 5-minute chart. You shouldn't be trading a stock long on a 5-minute chart if it's below the VWAP. You want it above the VWAP. The VWAP is extremely important, volume weighted average price. This is what the institutions all trade off of. So that is extremely important. We use it, of course, in the SPY super system all the time for our support resistance levels. And number 11, fear of missing out. It's emotion. This is, we talked about, this is emotion. Chasing fast-moving stocks based on the emotion that you are missing a big trade. And that's what FOMO is. FOMO is emotions. Obviously, it's greed. You think you're missing out on a big trade. Look at all these other people that are in this trade. I got to get in this. It's a nightmare. It frequently ends with traders entering near the high or low and getting trapped. Because if you're in it and it's way away from support levels, and you get into it near the high, and then it starts to go back against you, are you going to be able to stand that until it goes all the way back to support again? Probably not. You're probably not going to be able to. And somebody else who's being patient and waiting will see that stock come back. It was very strong. It'll come back to support. It'll hit the support. It'll bounce and confirm that it's going back into the trend. And that's where they'll calmly get into the trade and sit there and start making money while you're sitting there licking your losses. All right. These frequently occur near the market open on gaps up or gap downs, or a fast move of a stock on the open, or you'll get a news event that will cause the stock to really move one direction or the other. That's what generally does that. All right. And trading these emotions will not end well. And this is the whole key here. Try not to trade emotions. So those are the 11 that I think are the most critical mistakes that most retail traders make. I've made them all in my career, and I think most everybody probably has suffered from them. I can't change anything. All I can do is point them out to you. I can't take emotion out of your trading, but I can point out methodologies that we use that eliminates emotion by sticking to criteria. All right, and here they are. Here's the criteria for a high probability swing trade. The current and multi-time frame momentum on the SPY super system should be aligned on the daily chart. Blue or green for long, and red or yellow for short. You've got to have that. The daily chart must be technically bullish for long and technically bearish for short. You've got to have it. The daily support and resistance must be identified to determine if there is enough room to justify the risk of taking the trade. Again, a recent Fibonacci reversal candle on the daily chart will add to the probability of success, because a Fibonacci candle inherently is confirmation. And be aware of when earnings will release so as not to hold over earnings. That's a high probability trades for swing trades, right? And again, if you do that, almost all of the things we just talked about for errors are going to disappear. And the criteria for high probability SPY super system intraday trades using 5-minute candles for the indexes, all right? The SPY, the Q, the IWM. Current time frame momentum, blue or green for long, yellow or red for short. It's got to be. The VWAP uses support and resistance level for the trade entry, or the 15 EMA uses support and resistance for the trade entry if the price is moving away from the VWAP. Either one of these becomes support and resistance. Market trend. We talked about this at number 1, right? If choppy trades have a lower probability and size, and profit targets would be smaller. All right. So again, the choppy market is going to reduce your probability of success by quite a bit. The strongest index for long and the weakest index for shorts. So if the SPY is up 1.5%, the Qs are up 1%, the IWM's up 0.5%, then you would initially take the SPY because it's up the most. But you have to make sure that it's got enough room to the upside or to the downside to justify taking the trade. Okay, because it is a type of relative strength or relative weakness comparing it to the other indexes. And again, identify nearest support and resistance in the daily chart and use that in the selection of the index to trade as well. And use a Fibonacci reversal candle for entry in the trade, which will give you confirmation of the reversal of the trend. Right, so there is the criteria that we use. That is going to, if you stick to those, you're pretty much going to eliminate most of the emotional trades that we talked about earlier. And that's it. I hope that you can find this useful. Again, I can't fix any of these things. Just remember that guy. That's what happens when you trade your P&L. And again, not considering this is the biggest one here. Market first. The market is the most important thing of all. It drives most of the trades in the market, and all the rest of them we covered. I hope this helps a little bit. See if you can identify some things that perhaps apply to you, And if you have a problem and you make a losing trade, or you get out of a trade when you shouldn't, make a note as to why you did it. Was it one of these, or was it something else that caused that? All right, so really, really important. All right, so I'll leave you with that. Again, thanks so much for listening to it. I hope this helps. Again, I'm Dave with the SPY Super System Trading Room and Alert Service. Trade 5 days a week, market open to market close, call out trades all day. We have the SPY Super System set up right there in the room, so I can identify SPY Super System setups as well as swing trades. Have a lot of traders in there who are asking questions all day, so we do a lot of education. So again, thanks very much, and I appreciate you watching the video. Try to avoid these mistakes. All right, have a great weekend. Hope to see some folks in the room.